Everyone thinks central banks print physical cash when they need more money. They're wrong, and what they actually do is far stranger. For most of us, money feels solid. You earn a paycheck, it hits your account, you spend it. But central banks don't work that way. When the Federal Reserve or the European Central Bank decides the economy needs a boost, they don't fire up printing presses in a basement somewhere. Instead, they sit at computer terminals and type numbers into existence. That process is called quantitative easing, or QE. Here's how most people picture it. The economy slows down, unemployment rises, and the central bank's job is to get cash flowing again. They print new bills, pump them into banks, and suddenly there's more money circulating. Sounds straightforward, right? The problem is that explanation misses the entire mechanism. When the Federal Reserve does QE, here's what actually happens. They create a digital account balance, electronic money, not physical currency. Then they use that balance to buy government bonds or other assets from banks. The banks receive a credit to their account. Instantly, there's more money in the system. No printing press, no truck delivery, just a keystroke. Think of it like this. You and a friend keep a shared ledger of who owes whom money. If you want to lend him $100, you don't hand him bills. You just write down that he now has a credit of $100. The central bank is doing the same thing, except they're the ones who control the ledger for the entire financial system. But here's where it gets complicated. When central banks buy assets, especially government bonds, they're removing them from the market. That changes prices. Bond prices rise, interest rates fall. Banks have more cash, so they're more willing to lend. Businesses and people borrow more cheaply. Spending increases, that's the intended effect. Now let's examine what actually gets undermined in the traditional story. The real implication of QE isn't just more money exists. It's that the central bank is directly influencing asset prices. They're not neutral observers. They're active market participants, buying trillions of dollars worth of bonds. That shapes who benefits and who doesn't. When asset prices rise due to QE, people who already own assets, stocks, real estate, bonds, see their wealth increase on paper. People who don't own those assets don't benefit the same way. Savers with money in low-interest accounts see their purchasing power erode as prices for goods and services gradually climb. This is one of QE's core trade-offs. There's also the question of what happens when QE stops. Central banks eventually sell those assets back or let them mature. When they do, they're removing money from the system. That can be destabilizing if timing is off. It's like removing water from a bathtub that's gotten used to being full. The pipes aren't always ready for the drain. QE also depends on a working financial system. If banks aren't lending, or if people aren't confident enough to borrow, the new money just sits in bank reserves. During the 2008 financial crisis, that's partly what happened. The Fed created trillions in QE, but the money didn't reach Main Street immediately. It took years for that liquidity to circulate. The deeper implication is philosophical. Quantitative easing reveals that modern money isn't backed by gold or any physical commodity. It's backed by the central bank's credibility and the belief that the currency has value. QE tests that belief. If people lose confidence that the central bank can manage the money supply responsibly, the whole system becomes fragile. So quantitative easing is neither magic nor simple stimulus. It's a tool that reshapes who holds wealth, how much borrowing costs, and what savers earn. It works by changing the supply and demand for assets, not by physically injecting cash. Understanding that mechanism, rather than the myth of the printing press, is what separates informed observation from guesswork about how modern economies actually function. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next breakdown of how financial systems actually work beneath the headlines. This video is for educational and informational purposes only and is not financial advice. Always do your own research.